I don't normally do the same person twice in a row, but this interview between Kathy Newman and Jordan Peterson was just too interesting of an opportunity to discuss how you can handle someone who uses
order types are instructions to your broker about how to execute your trade. You don't need to know the complicated jargon or hand signals traders used to use on the floor of the New York Stock Exchange.
NASDAQ 100.
Yeah, the NASDAQ 100 is now up 23% since hitting its low back in December. And it's like the banking turmoil never happened. I think the market is looking at the Fed. And
the price could drop further by the time the market order is filled. This could lead to a share sale at a price lower than what the investor intended. Likewise, if an investor
So in business, they call this assuming the sale. Like when a car salesman says, so would you like that with the leather interior or with the fabric interior, before you've even decided to buy the car.
Microsolved anomalies rarely make the evening news, yet they provide market makers with a continuous, legal data advantage. Market makers exploit subtle microstructural tricks to keep odd lot orders hidden from the public tape, quietly tilting the playing field in their favor.
I don't normally do the same person twice in a row, but this interview between Kathy Newman and Jordan Peterson was just too interesting of an opportunity to discuss how you can handle someone who uses subtle conversational tricks to bully you into looking dumb. So in this video, you're going to see firsthand some of the most common tricks that people might be using on you, and you're also going to learn how to reverse those so that you can walk out of a kind of aggressive situation having earned more respect than you had going in.
Just like an aggressive debater using clever rhetoric to corner an opponent, high-frequency firms rely on stealth tactics to outmaneuver retail participants. Before any order enters the market, the trader must select an instruction type that ultimately determines how much execution control they yield.
Because before placing that order, they have to choose an order type. Simply put, order types are instructions to your broker about how to execute your trade. You don't need to know the complicated jargon or hand signals traders used to use on the floor of the New York Stock Exchange, but you should understand the basic order types and how they affect your trade. Let's focus on the basics of how an order is placed. Then, 3 common order types: market orders, limit orders, and stop orders.
These standard order rules may seem routine, but they act as the primary gateway where retail flow is segmented and redirected. While mainstream financial media highlights booming tech, stock rallies, and corporate earnings, the plumbing of the market faces a silent liquidity fragmentation.
Investors ought to be thinking about right now. Tech stocks drove the market higher as investors looked beyond rising interest rates. Banks began to stabilize, but there's still questions over whether the worst is yet to come. And Walmart gets an upgrade as it takes a few pages from the Amazon playbook. What does that tell us about the broader market? On the Barron's Roundtable, my colleagues Ben Levison, Carl English, and Jack Howe.
This top-level stability mass, the microsecond level order, imbalances where retail market orders are quietly internalized. Market makers count on retail traders remaining completely unaware of how artificial spreads are structured on the public tape.
First off, to stop a conversational bully, you have to realize what's going on before it's too late. Now, typically a person will reveal their aggressive attitude early on with their tone of voice and their word choice, kind of like this.
But it's not, I wasn't specifically aiming this message at young men to begin with. It just kind of turned out that way.
And it's mostly, you admit, it's mostly men listening.
In this case, Kathy is indicating very clearly that she thinks Jordan has done something wrong.
Once you look past the official quotes and spot these structural traps, the illusion of a fair pricing system quickly fades. The moment a retail trader hits execute, their aura enters a labyrinth of routing systems where real-time prices shift constantly.
Your order is sent to your broker, who attempts to fill it on the market. Prices can change constantly, and the system for routing orders has lots of moving parts, all of which impact how quickly and at what price your order is.
These routing friction points are small, but they give high-frequency algorithms the microsecond windows needed to optimize their own spreads, with stock indices pushing toward new highs. Regulators often overlook the hidden structural gaps in everyday retail transactions.
About the Fed and rates and a banking crisis and inflation, and we missed the start of a new bull market, at least in the NASDAQ 100.
Yeah, the NASDAQ 100 is now up 23% since hitting its low back in December, and it's like the banking turmoil never happened. I think the market is looking at the Fed and saying, hey, rate cuts are going to be done. The banks are not going to be a big deal. And hey, look, Apple and these other big tech stocks that we love, they're going up again.
Microsecond anomalies rarely make the evening news, yet they provide market makers with a continuous, legal data advantage. Sophisticated trading algorithms use solid block orders like exploratory radar, sending tiny bids into dark pools to map institutional block levels.
When she implies that he should be bothered for being divisive. Just watch.
Does it bother you that your audience is predominantly male? Isn't that a bit divisive?
The point here is that even when they're being passive-aggressive, people will often indicate that they're about to attack you before they actually do. So if you hear someone say something like, well, what do you have to say for yourself? Be prepared. That person thinks that you've done something wrong and you need to be very careful what you say next. Not because you...
This tactical probing allows market makers to squeeze institutional execution quality without ever signaling their intentions to the broader market. When price volatility spikes, choosing an immediate execution style leaves the trader highly vulnerable to shifting spread dynamics.
This order type indicates that you want your order filled immediately at the next available price. If prices are changing rapidly, the next available price could be different than the price quoted when you initially place the order. Investors who use market orders tend to be more concerned about the speed of a trade than the price. The lack of restriction on price means this order type has the best chance of being filled, but it also has the risk of being filled at a different price.
In fast-moving markets, retail brokerages frequently guarantee best execution, yet they evaluate their performance against an incomplete public price state,
so that they can attack that straw man. And the first way that this often happens is called the "so you're saying" trap. Here's what it looks like.
And
So
that
you're
can
saying
rely on.
women have some sort of duty to sort of help fix the crisis of masculinity?
Which
Women want
domination.
to dominate. Is that what you're saying?
No,
Right, so you're saying that anyone who believes in equality, whether you call them feminists, call them whatever you want to call them, should basically give up because it ain't going to happen. Let me just get this straight. You're saying that we should organize our societies.
This regulatory benchmark misses superior prices resting in private engines, masking the true cost of execution. When market panic sets in and prices begin to plummet, relying on standard market orders can quickly result in devastating slippage.
Example, if the price is plummeting and other investors are also trying to sell, the price could drop further by the time the market order is filled. This could lead to a share sale at a price lower than what the investor intended. Likewise, if an investor places a market order after hours, the price could be very different when the order is filled at market open. Because of this, investors typically use market orders during trading hours and in highly liquid markets.
This rapid price decay proves why execution speed means very little if you cannot control the actual execution price. When isolated market sectors face sudden liquidity shocks, execution quality can deteriorate in the blink of an eye.
Called it's the Invesco S&P 500 Pure Growth ETF, RPG. I had to look at that. It's actually down 0.3%, and that really tells you everything you know. This is all about big tech.
So this turmoil under the market that's causing problems everywhere, but I guess big tech is now the flight to safety, kind of. How will this turmoil manifest itself, do you think?
Well, it's going to be interesting to watch. I mean, we have the debt ceiling coming up still, and that's going to be exacerbated perhaps by the indictment of former President Trump. We also have a problem with lending, even though the banks are...
Market makers immediately adjust their internationalian parameters during these spikes, shifting the risk back onto retail traders. High-frequency algorithms analyze market patterns too, predict where retail order clusters are likely to form.
Is that someone says, "so you're saying," and then proceeds to oversimplify or mischaracterize what you actually said. I won't spend too long here because it's very easy to spot and it's rather simple to avoid and get around by saying, well, actually what I was saying is, and then repeat yourself.
Along the lines of the lobsters.
I'm saying that it's inevitable that there will be continuity in the way that animals and human beings organize their structures.
By anticipating these predictable structural formations, algorithms can systematically clear out local liquidity pools ahead of major price moves. For traders looking to preserve their entry or exit, prices utilizing limit orders offers a way to bypass the uncertainty of immediate market fills.
Highly liquid markets. This increases the chances of getting an order filled closer to the requested price. If your priority is to buy or sell at an exact price or better, you may want to use a limit order instead. With a limit order, you specify a price, and the order won't be filled until the stock can be bought or sold at that price or better. However, because of the price restriction, there's no guarantee the order will be filled quickly or at all.
Controlling the transaction price is a vital defense, even if it means waiting longer for execution. Behind the scenes of retail trading, market makers act as underwriters, pricing risk and absorbing transactional imbalances.
Perhaps by the indictment of former President Trump. We also have a problem with lending. Even though the banks are not really blowing up anymore, we can probably assume that they're going to be lending less. And that's going to be a pretty big problem for the economy. And we're going to have to watch for payrolls next week to see if the job market is holding up or if it's holding up a little too well.
Yeah, exactly. So, Carlton, Ben referenced the banking crisis, I guess, mini crisis at least, in regional banks. It seems to be stabilizing. Are you comfortable?
Then, times of macro uncertainty, these underwriters prioritize their own balance sheets, widening the spread for retail order flow. Algorithms often analyze order flow patterns to make immediate, highly accurate assumptions about short-term market direction.
It's when someone's words imply that you believe something you don't, and they don't actually say it. So in business, they call this assuming the sale. Like when a car salesman says, "So would you like that with the leather interior or with the fabric interior?" before you've even decided to buy the car. Now, with a several $1,000 purchase, you're likely to notice this and say, whoa, who said I was buying in the first place? But it's very likely that this is happening to you in conversation all the time and you don't even notice.
These automated systems assume that retail order flow is mostly uninformed, positioning themselves to capture the spread on every trade. Setting a precise target price with a limit order prevents traders from overpaying in an unpredictable market.
Investors generally use limit orders when they have a target entry or exit price and are willing to wait for the market to move in their favor. Let's say, for example, that a stock is currently trading at $55, but an investor believes it'd be a good value at $50 or less. This investor could place a limit order to buy the stock at $50. If the stock never reaches the limit price, the order would never be filled.
While this pricing threshold offers essential protection, it also means your order can sit unfilled if the market fails to hit your target. As global interest rates shift and macro liquidity thins out, market makers face higher costs to carry trade inventories.
Crisis, I guess, mini crisis at least, in regional banks. It seems to be stabilizing. Are you comfortable with where it's going?
I mean, you are correct. It does seem to be stabilizing. The banking sector was on pace for its worst showing since the onset of the pandemic. But, bank stocks were up closing out this week. I still think we're going to be seeing a little bit of noise in the sector. To Ben's point, we are going to see banks not lending as much. Well, that's how they make their money. So we're also going to see deposits.
To protect their profitability, these firms widen odd-lot spreads, directly passing cost of capital onto retail participants. Many self-directed investors fall into the trap of assuming that the standard broker chart displays the complete market picture
all the time and you don't even notice. Here's how it might look.
Yeah, but
And
those
aren't being
reasons,
taken into
why
account.
should women put up with those reasons?
Embedded in the question, why should women put up with it, are several important presuppositions, namely, one, that there is something to put up with, and two, that Jordan thinks women should put up with it. Now, the trap here for Jordan would be to answer Kathy's question directly, and many of us fall into it in similar situations.
This fundamental. Once a stop order hits its activation threshold, it transforms into a standard market order, accepting whatever price is currently available.
Up to $50 or below, with enough volume available at that price, the order will fill and the investor will buy the stock for $50 or less. The last order type is a stop order, which is actually just a market or limit order with an activation price that triggers the order. When the stock reaches the activation price, the order is executed according to its order type. Stop orders can be used in various ways. Investors can use buy stop orders to buy securities when they reach the activation price, or they
Because hidden odd-lot quotes are omitted from public views, the final execution price often slips well below the expected trigger level. High-volume surges in isolated market sectors can overwhelm traditional order books, distorting execution quality.
Going to see banks not lending as much. Well, that's how they make their money. So we're also going to see deposit costs going up for banks. So that's going to squeeze profits. So I think we're past, the kind of catastrophic shocks that we saw over the last few over the last few weeks. But I do think it's going to be bumpy. I still like the sector, but it is going to be bumpy.
That pullback in lending, I think, hasn't been fully priced into either the Fed's view or market yet. I'm worried about that. But one specific area of lending is interesting. Barron's does a deep dive into commercial.
This Decoupling of public indices and private execution pools reveals a glaring structural vulnerability in modern market design. High-frequency algorithms listen carefully to order flow, analyzing subtle shifts to verify support levels across various venues.
Hidden presupposition and then call it out. So watch how carefully Jordan listens to Kathy's questions so that he can catch what she's not saying.
Why should women be
put up with it?
content
I'm not
not
saying
to
that
get
they
to the
should
top?
put up with it. I'm saying that the claim.
Here's another example of assuming the sale from later in that conversation. See if you can spot the hidden presupposition and ask yourself what you might say to respond to it.
By probing the order books, placing a limit order inside the public spread is a popular retail tactic, but odd lot sizes do not enjoy the same queue priority.
Or they can use sell stop orders when trying to limit potential loss in an investment. For example, an investor might set a sell stop order on a stock she owns, specifying that if the stock falls to a certain price or lower, it'll trigger an order to sell the stock at the next available market price. This could possibly prevent more serious losses by getting out before the stock falls too far. There are 3 types of stop orders: stop market, stop limit, and trailing stop. If the investor in this example uses a stop market order, when the
As a result, the market price can move completely past your target without your order ever receiving an execution fill. Much like modern consumer tech platforms monetize user data, retail brokerages rely on market makers to monetize their order flow.
Specific area of lending is interesting. Barron's does a deep dive into commercial property lending by these regional banks. When those leases come up, they may not be worth what they were worth when that loan was made.
Exactly, because what do we see? A lot of hybrid working, a lot of office space not being used. Now, this is, again, something to be concerned about. But when you look at the major lenders in the commercial real estate space, they're doing it because they know how to underwrite those loans. They have lower loan-to-value ratios.
Timing for order flow thrives on this segmentation, where odd lots represent the highest margin opportunities in the system. To spot where the real market liquidity lies, traders must look beyond basic charting platforms and inspect raw microstructure feeds.
So what's the hidden presupposition? That Jordan thinks women must have children. And of course, he defends a woman's right to make any decision about that she wants.
The right to choose those demanding careers.
They do. They can. Yeah, that's fine.
But you're saying that makes them unhappy.
Here's one more example. See if you can spot the hidden presupposition here.
So
Like,
you're
it's
not going to say to
seriously
your
not the
followers
same.
now, quit the abuse, quit the anger.
Did you catch it? The presupposition is that Jordan's followers are abusing people. Now, he can't answer that question directly. He has to
This granular data proves that a staggering percentage of high-priced equity volume is completely hidden from the public eye, while trailing stops are built to capture gains or limit downside. They still depend heavily on public quote updates to trigger
stop market, stop limit, and trailing stop. If the investor in this example uses a stop market order, when the trigger price or lower is reached, an order will be placed to sell the stock at the next available price. The benefit is that a stop market order may help get the investor out of the falling position quickly. The risk is that the next available price could be lower than what the investor anticipated. If the investor uses a stop limit order, when the stock falls to the stop price, it'll trigger an order that seeks to.
This dependency means a trailing stop may fail to adjust properly during rapid off-exchange odd lot transactions, as massive retail and banks talk straight at higher price per share values. Transaction sizes naturally shift toward fractional and odd lots.
Earnings coming up. What do you expect? I guess that's the big question, right?
Yeah, I mean, this one, it is always going to be about the talk and the forward outlook. What I am really going to be interested in, it's not going to be so much what the big banks say. There's a lot of stability there. We're going to be paying a ton of attention to regionals, which report later in April.
Got it. Let's switch to retail. Jack, Walmart has an investor day coming up. That's often positive. They seem to be trying to look at Amazon for some guidance.
This high-priced regime makes the exclusion of odd lots from official consolidated data an increasingly severe market distortion. Market makers can regulate the pacing of execution, intentionally adjusting routing speeds when retail flow becomes highly unbalanced.
He can't answer that question directly. He has to address that hidden point first, and he does.
Well, we'd need some substantial examples of the abuse and the anger before I could detail that question.
There's a lot of it out there.
When I cut the clips like this, it makes it very easy to see these hidden presuppositions, but in real time this can be difficult. One simple thing that you can do to make it easier on yourself is to purposely assume a relaxed posture, as Jordan does throughout this entire conversation. Now, this posture actually helps you to think less.
By delaying internal matching times, high-frequency algorithms gain the window needed to hedge risk before filling the retail trade, while a stop limit order lets you establish a strict execution boundary. It introduces the critical risk of missing the execution entirely.
The investor uses a stop limit order. When the stock falls to the stop price, it'll trigger an order that seeks to fill at the limit price or better. A potential benefit is being able to control what price the stock is sold at. But there's also a risk of the stock falling so quickly that the stop is triggered, but the limit order is never filled because the stock has fallen below the limit price.
In fast-moving markets, your stop may rigor, but the price can skip past your limit before the order can be filled. Although regulatory bodies periodically propose updating the round lot framework, institutional pushback remains highly coordinated.
Talking about high margin advertising businesses and the data businesses and their delivery service and all this. They've been making a lot of investments. What investors really want to know is, can they continue to grow the top line at, let's say, 4%? And can they continue to grow or can they get back to growing operating profit at something north of 4%? And that can decide what happens with the stock. It did get an upgrade this past week from Evercore ISI. They say that the investments Walmart has been making are working. They're
Keeping odd lots outside the national best bid and offer protects a highly profitable informational advantage for market makers. Until regulatory bodies mandate a unified data feed, retail traders will continue to face wider spreads and sell slippage.